So 90% of the investors lose money in the stock market, they say. Is that true? Well, there is no compelling data other than a bunch of anecdotes to suggest that 90% of the investors lose money. However, the number is significantly high. Well, life is full of risks and situations. The risk of a large tree falling over your parked car while doing no harm to anything else is beyond your control. While other risks, like some lifestyle diseases for instance, can be mitigated by adopting a healthy lifestyle. So investing is no different. Some investing risks are outside of your control, while many others can be minimized by using the right strategy. Yet, people lose money in the stock market. Let's look at some of the reasons as to why. Number 1, fear and greed. Investors of all kinds, however big or small, wise and imprudent, expert and novice, all are victims of this trap at some point in their investment journey. This phenomenon is attributed to conflicting human emotions. As John Keynes, the famous economist, calls it, animal spirits. Both fear and greed are primal emotions and are key for our survival. Fear is what has kept us humans from being eaten by predators, as we all know, or us jumping off a cliff attempting to fly, while greed has forced us to thrive and evolve and excel. So financial markets are also driven by these two powerful emotions. Greed, or FOMO as we like to call it, and fear attributed to loss aversion bias. The urge to enter the market when it's at an all-time high, and at the same time you're hardwired to panic sell when things spiral. Now, imagine a room full of investors acting purely on emotions. So many people are buying this stock. It's going to be huge. It's going to the moon, all that hype. And if the stock indeed goes parabolic, these investors will be kicking themselves saying, I knew it would go up, and they jump in to buy it. Fear of missing out. And here Mr. Market on the sidelines, watching quietly, roping in one after the other, with every higher candle and waiting patiently until the last one standing is roped in. And then the inevitable reversal follows, and fear takes over. Yet again, Mr. Market gazes at each one until the last one standing is flushed out. This is called buying high and selling low. In other words, greed and fear. And poor Elon Musk gets slammed for his tweets, or it's the Fed, or it's the government, and if there is no one, there is always the YouTuber who's probably going to get flayed for some random investor's personal decision to buy a stock. Well, this behavior will not just magically go away, but there is a way to control it. If you ever happen to face it, just pause, step away, have a cold shower if you need to, and come back with a solid game plan. Number 2, fast and furious. We're becoming an impatient society than ever before. To put that into perspective, it took 30 minutes to turn on a computer when it first came out. Yeah, 30 minutes. Except that what I just said is a lie. Sorry, but I bet you were stunned. So was I when I first heard that joke. That's because attention is a scarce resource these days. We simply cannot fathom waiting for 30 darn minutes for anything. But the truth is, we have come a long way. At some point in the past, not so long time ago, people waited endlessly to take a photo or even to dial someone. Today, apparently it only takes 3 seconds for people to decide if they want to watch a video or scroll past. But is that a problem? Well, if you're saving yourself from a flurry of YouTubers, maybe not. But from an investment perspective, impatience can bloody cost you. This thrill of fast and furious is best left to the racetracks because stock market tracks are too treacherous for this sort of approach. If you are the sort of investor who wants to make money and make it fast, then I'm afraid you're too fast. You may get lucky once or twice, but most of the time you will spend running up the down escalator. And on the flip side, when your portfolio is bleeding red, you need to hold your nerve and be patient for the long term. Because patience is a great virtue, both in life and in investing. There are absolutely no shortcuts to making money, even if it feels like it sometimes. If you invest in fundamentally sound businesses, you will be rewarded in the long run. You just got to be patient. Number 3, trying to catch a falling knife. In other words, not knowing when to say no. This catchphrase means buying a stock while it's still falling. A lot of investors buy stocks when they're dropping in value thinking it's a bargain. Well, while buying low is a right strategy, it's important to avoid buying when the price is dropping straight down with no sideways action. Most pandemic plays ended up being falling knives. PayPal, Peloton, Zoom, Teladoc, even Bitcoin. They all have tumbled to the ground over the last year and never recovered since. So if you had gone in at any point during the fall thinking they were a bargain, you would be back holding now for sure. So always wait for trend reversal before jumping in. At the risk of sounding too cliched, markets only favor disciplined investors. It also despises investors who spend more than their means, which means going in too quick or all in is a big no in investing. Number 4, over-concentration and over-diversification. Don't put all your eggs in one basket. We hear that all the time. That is over-concentration. A lot of investors stand to lose big bucks due to lack of diversification as stocks are subject to volatility. We know that. But a fair number of investors are also victims of over-diversification. Yeah, you can have too much of a good thing. For instance, investing in different companies but in the same sector could end up badly because any event affecting that sector can keep the prices across all companies in that sector low until the recovery. For example, between the second half of 2020 to almost end of 2021, for little over 12 months, the tech sector was on steroids. Stock prices across the board skyrocketed. But 2022 started with a big blow, and in no time, the entire landscape changed, tumbling the stocks down to the ground. Data suggests investors have lost roughly $7.4 trillion based on the 12-month drop in the Nasdaq. You probably know this sector has still not recovered, and there's plenty of pain to go around for most tech companies. Other instance of over-diversification would be to run into the risk of not understanding every business you invest in when you over-diversify. And it can become unmanageable, particularly if you're not an expert. You may struggle to keep on top of your investments when it comes to rebalancing or moving money, and might end up losing, defeating the whole purpose. According to Warren Buffett, wide diversification, in other words, over-diversification, is only required when investors don't understand what they're doing. While over-concentration or lack of diversification is damaging, as we all know, over-diversifying, in my opinion, is plain lazy, and stock market doesn't favor this strategy very much. While optimum diversification is very personal and subject to your circumstances, successful investors put their eggs in just enough baskets that they can watch closely rather than in too many baskets. Number 5, and the last one, following the crowd. As humans, we trust the wisdom of people in general to make certain decisions in life. Whether choosing a movie to watch, or buying a phone, or choosing a restaurant to dine in, we always look for confirmation from people around us. Even when following a YouTuber, if you only see a small number of subscribers or views, you promptly conclude that the content can't be any good. This is called the social proof bias. When we see a large group of people doing things a certain way, we assume that that is the correct way of doing it. For instance, when you park a car in a new area, you just follow others' lead. There is no way of knowing if others are right unless you check the rules yourself, and you end up getting a parking ticket. But unfortunately, unlike a small parking ticket, this behavioral bias can have some serious consequences in investing world. Neurologists have found that for a lot of people, the feeling of being excluded provokes the same sort of reaction in the brain as that of physical pain. So standing against the crowd is a big no for some, but I think that's dangerous in investing. I am not antisocial. In fact, I'm a gregarious and a social person by nature. But when it comes to investing, I believe in detaching myself from the crowd so I don't get deluded. While it's important to listen to different opinions, because that's how we learn something new and useful. Always make unbiased assessments of your investments and act independently where you can. Also, beware of the media who, more often than not, provide a high-pitched broadcast of popular ideas because they don't care about you. So, the important takeaway from this is every investor has their own story, a mix of failures and success. We must learn from past experiences. Well, it's not easy to make decisions when emotions are involved, and money unfortunately evokes emotions. Most of us don't make investment decisions without it being supported by a narrative or some form of story. But it's important to understand the stories come with their own set of objective facts as well as contradictory elements. It's up to investors to process the available information pragmatically and make informed decisions. Happy investing and invest wisely. Take care.